Welcome back to watching the newsroom. Canfin Homes is the stock in focus right now. The stock, a lot of strong commentary coming in, and the housing finance companies are also being seen as a proxy to real estate recovery. So Girish Kousgi is joining us now, MD and CEO of Canfin Homes. Girish, afternoon. Thank you so much for your time. We understand that the outlook at Canfin Homes has improved a whole lot. Uh, you are seeing very brisk business, and I'm sure it will translate to improved earnings as well. Talk to us about, as you sit right now, what kind of visibility you have on the business, and what kind of inquiries and uh, transactions are you seeing at your desks across the country?
Good afternoon. If you look at the market now, economic activity is improving with every passing month. If you look at GDP numbers, very, very encouraging. Real estate as a sector has revived, and I'm sure it will last for next 5 to 6 years. If you look at the home loan interest rates, it's at the lowest. So demand is robust, and this is true across geographies in almost all the small towns, mid-sized towns, and big cities and metros. So demand is very, very good. So it is not only good for Canfin, it is good for the entire industry. So housing finance industry now is in sweet spot, and for next 5 to 6 years time, it will be a dream run for housing finance companies. As far as Canfin is concerned, we would like to clock the highest ever growth for next few years, starting from this quarter onwards. If you look at the best ever quarter for Canfin, it was last to last quarter, that is quarter 4 of last year. And this quarter, we are hopeful of beating quarter 4 of last year, which means this quarter will be the best ever quarter in the history. And probably we'll try and do this, in every 2 or 3 quarters. So market is good, demand is robust, property prices at the lowest, and demand has picked up in the real estate space, interest rates lowest, huge liquidity with banks. I think everything is good. And because of COVID, now we see that consumers are looking for a bigger size properties, which means the ticket size also would inch up going forward. So all these things would help the entire industry.
Amazing answer. Girish, I've never heard a housing finance company so buoyant about future in a very long time. So thanks for sharing it. Tell us what kind of opportunities does it flow for you? What kind of loan book growth are you looking at? And also with these volumes and higher ticket sizes, tell us what kind of earnings outlook, not only immediate, but if you take 12 to 24 months far out.
Outlook is very positive. For a company like us, we were largely focusing on affordable. Even going forward, we will focus on affordable. Now we have little bit of pricing power, so which has helped us to focus on slightly better segments, and new geographies, new markets have opened up for us, which will also see us our ticket size slowly increasing. So for Canfin, it will be a dream run for next few years. Our focus is on small towns and in the outskirts of big cities. So large focus on affordable, and to a small extent, we also focus on Cat B corporates, Cat B developers, and we also get into some of the big cities in terms of trying to increase the ticket size. So in terms of outlook, with respect to growth, we plan to grow at about 18-20% in next few years.
Profitability, what about margins? How is your book value likely to improve going forward?
If you have seen Canfin has always maintained very good margins. We had a slight change in pricing strategy last year. That was because a lot of banks were focusing on mortgage, and that was due to lower offtake in corporate credit, and also because of COVID. So we also had taken a price cut, and we were pretty competitive in the market, and therefore we were able to grow our book. Now that phase is now over. So we had dropped a rate till about quarter 4 of last year. And in last 5.5 months, we have raised rates twice. So going forward, our margins, both with respect to NIM and spread, will improve.
Mm-hmm. What about risk? How's your asset quality likely to improve going forward or pan out going forward? Because growth has a downside which needs to be protected, and that is asset quality. How are you covering that adequately going forward?
If you look at our asset quality, it's been pretty stable. Portfolio is pristine. Even during COVID, NPAs didn't go up. It went up marginally. And I'm sure with new markets opening up, we'll be able to source slightly better profiles, fund on better properties, which will see increase in ticket size, which will enable us to grow our book. While we do all these things, our asset quality will improve from now on. So we are talking about growth of about 18-20% for next few years. Market is so big, demand is so robust. So this kind of growth will not endanger portfolio quality at all. This is not just for Canfin, this is for the entire industry, because next 5 to 6 years, at least we see that this industry will start growing much faster than it did before.
Girish, are you also looking at stressed portfolios of other smaller players in terms of acquisitions? Because that will also propel growth in a good manner. You'll be able to capture more market share. And there are a lot of stressed players who are not surviving. Of course, yours is a very sound franchise, and hence raising money is never an issue. But there are many players for whom fundraising is an issue and they are not being able to sustain and hence are looking to merging with bigger players.
No, at this point in time, we are not looking for any stressed asset buyout or a portfolio buyout or a portfolio sellout. We want to grow our book. Now, while liquidity has drastically eased, I think going forward, even the smaller HFCs would be able to raise credit at the right rate, compete and do good business in next few years. So I think that issue which was there probably for last 4 to 6 quarters now has eased to a large extent. As far as we are concerned, we don't intend to either buy or sell portfolio.
Right. Girish, one last question. You are in such a sweet spot. Business is so good. Are you being approached by private equity companies or big, large marquee investors so that they can also participate in this growth which you're offering?
I think if you look at a shareholding pattern in last 6 quarters, our mutual fund holding, which was little over 3%, I think today it's about 16+% as per declared sources. And if you look at corporate holdings, which was about 12%, today it is 26%. So if I may call as institutional holding in last 6 to 7 quarters, it has increased by 25%, which means 25% of the entire capital is held by corporates incrementally. So it has gone up by 25. Today, mutual fund is 16 and corporates is about 25. So both put together, it's about 41, 42. Out of this 42, I think 25% it was increased in last 5 to 6 quarters. I think that's the kind of demand. I cannot comment more on this. I think we focus as a company on operations, and I think market gurus, they would decide which company to bet on, which company to pick up.
I'm sure. I mean, the proof of the pudding is in eating, and opportunities. Investors always find opportunities in good quality companies such as yours and position themselves. Thanks, Girish. Great chatting with you.
So much.
And thanks for sharing.